It's a whole new world of diplomacy and maybe of monetary policy. So what difference will it make? This is Bloomberg Wall Street Week. I'm David Westin. This week, Rick Rieder of Blackrock on the Fed's starting to ease off the gas pedal and what it means for investors. Seth Sharma of Morgan Stanley on identifying asset bubbles and what happens when they pop.
Generally, tech-oriented bubbles tend to be good. Something good comes out of it. And I think that's true because it attracts a lot of capital.
And special contributor Larry Summers of Harvard on how we know whether the inflation we see is going away anytime soon.
I think yesterday will be remembered much more than most FOMC meetings as the beginning of the Fed's recognition that overheating is the issue.
It was a week of adjustment in how the United States deals with the rest of the world.
I conveyed to each of my G7 counterparts that the United States is going to do our part. America is back at the table.
As President Biden completed a European tour shoring up alliances, burying the hatchet between Boeing and Airbus.
Today, the U.S. and EU have taken another step. The deal on large civil aircraft includes a commitment for concrete joint collaboration to confront the threat from China's ambitions to build an aircraft sector on non-market practices.
And having a constructive summit with Russia's President Putin, albeit leaving much to be resolved.
What I'm saying is I think there's a genuine prospect to significantly improve the relations between our two countries without us giving up a single solitary thing based on principle and our values.
But as important as Mr. Biden's series of European summits were for the geopolitical world, the business and the financial worlds were waiting to see how the Fed would react to dramatically better economic data than it had anticipated. And on Wednesday, we got our answer. Not so much in what it did.
Today, the Federal Open Market Committee kept interest rates near zero and maintained our asset purchases.
As in what the dot plot signaled it is likely to do, pointing toward tapering its bond buying later this year and raising rates in 2023, if not before. And the markets? Well, the markets, they reacted as the S&P 500 was down almost 2%. That's the most since February, while the NASDAQ 100 had its fifth straight week of gains. The 10-year was basically flat, but the real action was in the short end, with the 2-year yield spiking up and the yield curve flattening pretty dramatically. To help us interpret all this for the smart investor, we welcome now Sarah Ketterer, co-founder and fundamental portfolio manager at Causeway Capital Management, and Rick Rieder of BlackRock, where he is chief investment officer of fixed income and head of global allocation. So welcome, Sarah. Welcome, Rick. Rick, let me start with you. I talked to Larry Summers earlier today, and he said he thinks this may have been one of the most consequential Fed meetings and announcements in recent memory. Do you agree with him?
I think it was a very significant meeting. I think, like he said, they rightly started to begin a process that is ready to go. I mean, the economy is moving at an accelerating pace, and we know the momentum of employment will continue. Is it the most momentous meeting we've seen? Boy, last year, I think people have to give credit to what the Fed did was historic. I mean, they stabilized the system last year, and they were innovative, they were thoughtful, and they were adaptive to what was happening. So this was a big meeting, but I think you also have to put it in perspective. They didn't change a lot. The dots moved forward, and the markets interpreted that quite a bit. But you've also got a committee that may not be there in this form when that time comes. So I think you have to put it a little bit in perspective. But the market movement was extraordinary.
So, Sarah, what about on the equity side, the reaction? Because as Rick says, actually, they didn't do anything. They moved some dots on a plot, basically, and they said they're going to think about doing something at some point. And yet there was real reaction, including some sell-off in the markets in some parts of it. Is the reflation trade over?
Likely, yes. The massive monetary stimulus period is likely soon to be over. Now, keep in mind, the Fed and other central banks globally are still engaged in QE, but just the signal that is to taper or come to a slow and gradual end. But it's a sobering effect that adds to equities, and those equities are the most speculative, where valuation is not, or seemingly not, used in determining their price. those are the ones that get hit the hardest, typically in this type of expectation of tightening.
So given that, and what I understand of your investment philosophy, I guess that sort of is music to your choir in a sense, right? That's where you were headed anyway. So is there anything different today than there was on Tuesday in terms of your investment, or are you just doubling down on the way you've approached it, Sarah?
Well, the big question for us at Causeway is will the Fed tighten prematurely? In other words, will the Fed decide to rein in monetary policy and perhaps begin rate rises prematurely, choke off what could have been an explosive growth with all the monetary and fiscal stimulus that's occurred, in which case the economically sensitive stocks commonly found in value portfolios may not perform well. And that's one of the reasons why we made a huge effort to reduce our exposure, because the stocks had already priced in so much good news in areas like financials and industrials and materials, because they would be the most vulnerable.
So, Rick, what about that? What do you appraise the risk of their acting prematurely now? Some people thought they were sort of late getting to the party, the Fed, in addressing inflation.
Listen, I think the Fed, I think they could start tapering sooner than, I think they could start tapering right away. I mean, they're not going to do that. But the system is overstuffed with liquidity. I mean, to put $120 billion a month into the system is too much, particularly when the Treasury's general account has put $1 trillion in this year. So, listen, I think the Fed could go. And by the way, I don't think it will have any debilitating impact on the further momentum on employment. You know, when you look at jobs hard to fill, when you look at job openings, we were in an extraordinary period of time. We can't find enough humans for the jobs that are available. So the Fed's should go. And I think it will be. I think markets will stabilize. Markets will start to realize that, gosh, you know, moving this a bit forward, and it's not going to have any negative effect on the economy, and it's time to go. But let us say, markets tend to overreact first, and then we'll adjust later.
Well, so let me put you on the spot, Rick. What's your best guess about what you think the pattern is from here on out? We got a July meeting, we got the Jackson Hole meeting. When do you think we'll actually have an announcement of the plan for tapering, and then they'll actually start tapering?
So, I mean, Jackson Hole is a pretty good time to lay out something where you can actually take the time, lay out the series of plans in terms of how you do it. Listen, I think they'll start the tapering this year, and then I think they can raise rates in 2022. Quite frankly, looked foolish saying this a few weeks ago, but I think they can move in 2022. And, you know, moving rates in the front end of the curve is not going to affect where borrowing really takes place. You look at what happened this week, David. You know, when you start to move, long end rates stabilize. That's where all the borrowing in the system happens for corporates, for mortgages. So I don't think moving. I think people underestimate. You want to keep long end rates stabilized. And I think, as Sarah said, you don't want to have people worry about overheating and the long end come under pressure, because that's where real velocity in the system takes place. That's where real borrowing takes place.
Sarah, as an investor, particularly an equity investor, how do you assess the value in the Fed taking a little bit of air out of the bubble, if I can use that term, taking a little bit of the froth out at this point? Because there has been a lot of money sloshing around, as Rick says, and I think one of the consequences of that is there are some companies that are doing better than, frankly, they ought to, given the merits.
But just think about stocks as they should be priced at the present value of all the cash they'll generate into perpetuity, discounted to present at some discount rate. And that discount rate is very much a function of where risk-free rates are. And this is where equity investing has been a little challenging in the last couple of years, because we've had negative rates, sovereign rates in some parts of the world, and we've had extremely low rates elsewhere. But as this normalization process occurs, with all this, again, it's not just the monetary accommodation, it's the fiscal spend that's occurred on top of it that is such an accelerant for economic growth. And to the degree that gets priced into rates, that should be excellent for those who use valuation as a method of stock selection.
So, Rick, given the fact that they've been expecting so much stimulus from, as Sarah says, not just monetary, but fiscal, really pouring into the system, does that create opportunities? Because some opportunities, whether it's on the fixed income side or the equity side, are undervalued, are actually underpriced.
Well, a lot of these stocks have
Sorry,
moved.
that was for Rick. Sorry, Sarah.
Yeah, okay. Sorry, you could take this one, Rick.
That's all right. So listen, I think the markets have done some real reevaluation of companies and presenting some real opportunities out there today. I think, quite frankly, the markets tend to look at themes. They were really hitting the technology, things like software. There's a lot of cash flow in some of the big established software companies, and it's been a great opportunity. Things like semiconductors and semiconductor manufacturers have come under pressure. That business is going to be on fire for a long period of time. And actually, we started to pick away a little bit in the last couple of days on some of the energy commodity that have come under a lot of pressure, because I do think you still have a tailwind that is pretty significant. We haven't had this dramatic overweight to those sectors, which have actually done pretty well. So we were picking away a little bit at that today. But anyway, it's healthy for markets to recalibrate. The markets, have gotten pretty overzealous in some areas. So I'm hoping, quite frankly, we get a bit more of this to put some money to work.
So Sarah, same question to you. Where have there been values, real bargains, if I can put it that way, in the equity market?
Well, there aren't many bargains to be found, but the stocks that have lagged, let's put it that way, are in areas that have had no interest to investors. And so they are sort of appealing. Whereas I wouldn't want to be in the cyclicals. Most of them now, just as a broad category, a lot of them have fully anticipated economic recovery. And especially areas like autos within the consumer discretionary category, where good luck buying a car, and they're expensive. On the other side, consumer staples, healthcare, especially pharmaceuticals, and utilities, so boring and so cash flow generative. That's what you want. Free cash flow now. So that's the cash that companies generate surplus to their needs. If you can get that up front, that's a shorter duration stock, and that, in our view, is ideal in this environment.
Coming up, we're going to have more with Rick Rieder of Blackrock and Sarah Ketterer of Causeway Capital as we turn from the markets to the economy and where it is headed, what that means for investors. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. The day after the Fed decisions this week, I spoke with Brian Moynihan, the chairman and CEO of Bank of America, and I asked him what he was seeing in the fundamentals of the economy, quite apart from monetary policy.
From a Bank of America perspective, you'd rather have the economy growing at a solid rate and unemployment down, because at the end of the day, that means great for the core business. That means great for the capital markets formation activity, less emergency and more normalized, and also it means great for loan demand. And loan demand we're seeing start to pick up slowly as we move through the months of April, May, and June, which is better than it was obviously last fall or coming into the early spring.
We're back now with Rick Rieder of Blackrock and Sarah Ketterer, co-founder of Causeway Capital Management. You were talking about cyclicals just a minute ago. This is a question of if the economy really is rebounding the way we think it is, what does that say to an investor? And by the way, are we maybe overvaluing the rebound in some places?
Yes, very likely. I have that my colleagues are so talented, and they'll pop in my office and say, some of these industrials are trading at valuations that exceed that of some of the great U.S. near monopolies, the likes of Alphabet and Facebook. So we want to own the near monopolies, because if you get that kind of consistent cash flow generation, and what's really important here is that something structurally has happened. We've gone through a pandemic. It's changed behaviors. And to the degree digital marketing accelerates, those two entities are likely to be beneficiaries, and there are others. So that's what we're looking for now, are structural winners post-pandemic.
Rick, I'm curious, do you see some possible pitfalls on the way to recovery? You mentioned employment a minute ago, and the fact that we're at record numbers of job openings now. We seem to be having a tough time matching up the people out of work with the people who are needed for work. Do you see, and we also have supply chain issues, do you see some potential stumbling blocks on this road to recovery that could affect an investor?
So, I think the odds are that the economy is going to continue to be very robust. There are a couple of things that have happened. The savings rates have grown precipitously in and around fiscal stimulus. Consumers have delevered. There's a CapEx cycle that's taking place that is immense, an R&D cycle that's taking place that's immense. That companies are loaded with cash. So, the tailwinds are pretty extraordinary. It's hard to see how the economy's not going to move forward. There are a couple of things you got to keep your eye on. Obviously, you've seen some increase in some of the COVID cases globally, some of the variant concerns. That's the big one that's in front of us that you got to be careful about. Supply chains are still there, and that is an issue. And outside the one that I keep an eye on, I think more than most, is China. The data in China this week showed some slowing. And China, the economy in China, the impact it has on global exports, emerging markets, et cetera, commodities, et cetera, is pretty significant. So we keep an eye on that. I mean, it's not that concerning, but it's definitely started to moderate. So those are the things I keep an eye on.
So, Sarah, one of the things that you focused on is pharmaceuticals. And goodness knows the pharmaceutical industry has come out to some extent a hero in all this with the vaccine. A lot of people thought was impossible. Experts thought was impossible within a year. And you look at the Pfizers, for example, of this world, they've done terribly well. What does that say to you as an investor? Are those fully valued, or are there opportunities there in pharmaceuticals?
David, they're not even close to fully valued. And some of them are, just think about what's in their pipeline, and you realize the market's not even paying for that. In particular, the large European pharmaceuticals, again, they generate free cash. They have a level of innovation that creates a pipeline that's valuable. They weren't necessarily all involved in vaccines, but they have so much else going on. And they have the deep pockets to buy the technology needed to be cutting edge. And then they pay a dividend. And there's a lot to be said for that cash up front, particularly in an environment where markets have been so buoyant. Now we really need that income compounding.
Well, that's a very good point, actually. When you're changing the interest rate, that really does affect the discount rate on equities, right, Rick? So it really puts a premium on people getting the money up front, as it were, rather than waiting for a long time.
Yeah, I mean, you look at some of the valuations, some of these companies that were trading at 30, 40 times revenue. You take an NPV of that. When you move the interest rate, and you change it pretty significantly. But listen, I think you got to put a bunch of this in a perspective. We're going to be in a low interest rate paradigm for a really long time. By the way, the ECB is not going to move rates for years. And so I think you're going to be in a low rate environment for a long time. And this Fed, as much as we've pulled forward what they're doing, listen, I think the terminal rate is still going to be low, and that's part of why you're seeing back-end interest rates stay at such low levels. So I still think the discount rate on equities is still going to be attractive, and the cash flow generation from equities, particularly versus much of fixed income, is still pretty attractive. The cash flow yields just dwarf what you can get, particularly in high-quality assets in fixed income. There's some yielding assets make a lot of sense, but boy, it's hard to argue. And there are companies that will throw off 12 to 15, 20% ROE in this environment and throw off a lot of cash flow, free cash flow yield. That's still pretty attractive, even if you nudge up the discount rate.
But Rick, how much of the growth we're seeing right now or projecting is because of all that fiscal and monetary stimulus you talked about earlier? I mean, is this going to convert into, first of all, getting everybody back to work, because you need more people working in order to get the true growth going, and also productivity? You mentioned CapEx. Do you think that translates into productivity, Rick?
100%. I mean, by the way, even look at the Fed projections. They've got the unemployment rate getting under 4% by next year, the end of next year. Listen, I think you're going to see explosive growth of employment. We've hired 1 million, non-seasonally adjusted the last 4 months. You've hired 1 million people. You can't processing that many people. And I think you'll see some big numbers over the next few months. But gosh, I think when you put CapEx into motion, when companies, you think about what they did during the COVID experience, particularly at the beginning, they borrowed a lot of money. They're sitting on a lot of cash, and their free cash flow generation is high. The animal spirits at companies that will allow them to do CapEx, R&D, M&A is substantial, arguably as high as I've ever seen it. So that tailwind for economic growth, that tailwind for corporate progress, I think is going to be pretty significant going forward. So, I think you can get into 2022. I think we're going to see 8% GDP this year, real GDP, and I think you're going to see well into the 4s next year. It's pretty good numbers for when you think about a demographic or potential growth in the economy that's in and around 2%.
So, sorry, I'm really curious about this because just coming to a new Rick raising this, not all corporations, I assume, are created equal in terms of their ability to put capital investment in and get productivity out. Some presumably are more sensitive to that than others. Do you take that into account in investing? Say we think that this sector or these corporations can gain a lot more in productivity from capital investment than others, Sarah?
Well, often it's the tailing off of CapEx and then the release of free cash flow that makes a particularly good investment. So it somewhat depends on how quickly that return can be achieved off the CapEx. If it's, for example, a combination of CapEx and OpEx associated with, say, migration to enterprise cloud, that could pay off very quickly. And then there are other CapEx that is a little slower. But I just want to get back to what Rick said about some of the beneficiaries, maybe some of the biggest beneficiaries of the environment we're moving into, at least we think so at Causeway, are the travel and hospitality-related stocks. They're sprinkled all over various industries. It's not just transportation. Look at things like travel software, for example. There is so much upside potential remaining in these stocks. They're probably the last great shining area that's attractive for investors, only because we've just started. If the Chinese economy is a little slow, it's partly because they're only partially vaccinated. That Europe's not even, they're not finished yet. We haven't really come out of this pandemic yet. The border to Canada is still closed. There's so much more to go, and we have that to look forward to as equity investors.
Yeah, it's fascinating. Very, very quickly here at the end, Rick, we got through the whole thing without talking about inflation. Do you think the Fed took care of that for the time being?
I think they're right. I think the inflation is largely transitory. Right. And I think some of these shortages you're seeing will work their way through. So I think so generally.
Thank you so much. This has been a great roundtable. Really appreciate it. It's Rick Rieder of Blackrock and Sarah Ketterer of Causeway Capital Management. Coming up, we take a look at the week ahead on global Wall Street. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. It's time now for us to take a look at what's in store next week on global Wall Street.
David, here in Asia, we will be checking in with different policymakers across the region with a rate decision due from the Philippines, where COVID cases remain elevated and vaccine coverage low. The Bank of Thailand's policy update comes ahead of tourist destination Phuket reopening to quarantine-free travel in July. And on the corporate front, SoftBank Group and Reliance Industries are slated to hold AGMs, and Toshiba's shareholder meeting on Friday will be in the spotlight following an independent probe that unearthed governance problems at the Japanese conglomerate. Also, here in Hong Kong, we will see the first trial under the national security law. It is scheduled to take place over 15 days, but could be extended. Anne-Marie?
Thanks, Sophie. Next week, the big event is Eurozone PMIs, especially since a spike in inflation has caused the Fed to lean more hawkish. We also are going to be passing the June 21st original deadline of economic COVID restrictions being lifted on the UK economy that has now been abandoned. Romain?
Thanks, Anne-Marie. The FOMC meeting this past week shook financial markets as policymakers signaled a sooner than expected increase in benchmark rates. Investors now looking to the week ahead for clarification of that shift, with at least 6 of the 12 regional Fed presidents scheduled to speak publicly. Those speeches will be bookended by an appearance by Fed Chair Jerome Powell at a congressional hearing on the central bank's pandemic emergency lending and asset purchase programs. Crowding the spotlight during the week will be a slew of economic reports, including home sales, durable goods, and personal income and spending data, as well as the results of the Fed's latest stress tests on the largest banks in the U.S. The banks that pass muster with sufficient capital will be freed from those pandemic dividend limits. David?
Thanks to Sophie, Anne-Marie, and Romain. Coming up, bubbles everywhere. But are they really bubbles? And what does it look like if they pop? Ruchir Sharma of Morgan Stanley puts some of what we're seeing now into an historical context.
Bubble is not just something about one stock rising. It's a concept. It's about the fact that everyone believes in some new thing, that this concept is here to stay and about to change the world. So it is, as I say, a good idea gone too far.
This is Wall Street Week on Bloomberg. It's hard to talk about investments these days without hearing the word bubble.
We have an asset bubble.
So I don't think we've got a broad bubble.
Historically, it's indicative of a bubble type environment.
You look at Bitcoin, it doesn't have any income. So it's a pure speculative, self-fulfilling bubble.
But for all the talk, how can we tell what's a bubble and what's not? And what happens if it is a bubble and it bursts? Morgan Stanley's Ruchir Sharma decided to go back in history, analyzing the 10 biggest bubbles over the last century, everything from the U.S. stock market in 1929 to Chinese shares in 2015. And what they had in common was a price that rose 100% in the year before they peaked, with much of the gain packed into frenzied trading in the last few months, as day traders and other latecomers came rushing in. So, if history is a guide, where do we see those traits today? Ruchir Sharma says SPACs certainly make the cut.
I think that SPACs are very much here to stay.
Clearly, there's a lot of hype.
As do cryptocurrencies.
I think Bitcoin will be somewhere between 40 and 55,000 for the next chapter before it kind of builds up enough new momentum to take out that 55,000 and end the year much higher.
But some people insist that, far from a bubble, crypto is actually a hedge.
If you're looking for a safe haven, I see Bitcoin as the most secure, most reliable, most certain thing in the entire economic universe.
If things like SPACs and crypto do prove to be real bubbles, things could get ugly. As Ruchir Sharma's work shows, historically, when bubbles burst, they take roughly 70% of the asset's value with them. But Sharma admits that it just may be different this time, given how much liquidity there is in the market and a commitment from central banks to easy money, the likes of which we've never seen before.
Now really the focus is on, can we make sure that the liquidity that's gone into the system, the support that's been provided, translates into long-term sustainable growth.
We welcome back now to Wall Street Week Ruchir Sharma, the man who's done this work on the history of bubbles. He is the chief global strategist for Morgan Stanley Investment Management and author of the book, The 10 Rules of Successful Nations. Ruchir, thanks so much for joining us. Fascinating study you did, but take us through it a bit. You went back over 100 years, the 10 biggest bubbles. What were the things that you found in common about these bubbles?
So what I did was to look at the 10 biggest bubbles of the past century and see what were the common features here. And some objective characteristics were present in all the bubbles, and some of it was obviously subjective. But the one common factor was this, that typically a bubble is a trend that has been going on for a while, and in the final year, the final 12 months, you see a massive acceleration in that trend, with prices increasing by typically 100% over a 12-month period, and a lot of the gains packed into the last few months of that 12-month period. So that is the most objective criteria of looking at any bubble. The more subjective one is that it's also accompanied by a lot of speculative activity, frenzied trading, mass retail participation. Those are some of the other subjective criteria that go hand in hand.
I think it's fair to say just about every week we're seeing some frenzied speculation someplace or the other, but applying your objective criteria, that 100% run up to the peak, what do you see right now in the marketplace? Where do you see things that fit those criteria?
So I think if you look at both the objective and the subjective criteria, and remember, about a bubble is not just something about one stock rising, it's a concept. It's about the fact that everyone believes in some new thing, that this concept is here to stay and about to change the world. So it is, as I say, a good idea gone too far. So what is it in the marketplace today that we see which looks like a bubble? So I think that you see this in obviously some of the cryptocurrency space. We see this in some of the clean energy stocks. We see this in some of the SPACs. We see this in some of those pandemic stocks, the small cap stocks, which have benefited a lot because of the pandemic. And we also see this in some of these tech companies that really have no earnings. So there are various indices on Wall Street that define these trends. And these are what I call bubblets. And I think that this is a slightly new concept. Bubbles are the entire market wide, right? That you had the big bubble of 1929, you had the Chinese A-share bubble of 2015, you had the gold bubble of the 1970s, oil. Those are the really big market bubbles. But I think that one step below that is what I call bubblets. These are not market-wide bubbles, but sector-specific bubbles.
Ruchir, as you look at past bubbles or bubblets, Do you see situations where there's a correction then it resumes its rise up, or is there a correction and it resumes its fall down?
That's a great point, David, and we looked at that specifically. And here's what I came up with, which is that if you look at most trends, nothing goes up in a straight line. It only seems so in retrospect. But typically what we found was that you have drawdowns of around 20-25%. Those do not classify as a break in trend. But once any of these trends decline by more than 35%, that usually marks the end of the bubble. That means the trend is broken. And they often go on to decline as much as 70% from the peak over a 2-year time horizon. So that is the broad template. And what we see in the bubblets today is that most of them have declined by more than 35%. So that's what makes me feel that the trend is broken in many of these bubblets, and we may have further downside in the months, if not quarters ahead.
One of the big debates going on in all sorts of ways, including with inflation and other things right now, is it different this time? And certainly it is different, at least in the fact of a very rapid fall in the economy as we shut it down, and then a very rapid rise. But it's also different in the degree of monetary and fiscal support for the economy. Could that make us have a different result when it comes to your bubblets?
Yeah, it's entirely possible. We have never had such an extraordinary accommodation in monetary policy and fiscal policy to go with it. There's one statistic I keep repeating, which is that 20% of all the dollars in circulation in the world were printed just last year. So that's an extraordinary amount of monetary accommodation. And even if you end up getting some hawkish noises from the Fed and other central banks, to reverse that accommodation will mean a lot.
Ruchir, Jay Powell, the chairman of the Fed, hardly has an appearance that he isn't asked about bubbles, whether we're creating a bubble because of monetary policy. Thus far, he says that there is some froth, but he doesn't really see it. But let me ask a different question, which is there anything the Fed can do about it? We saw this week in the FOMC decision and then Jay Powell's remarks, and of course that dot plot, some indication that at least the Fed is going to come off of the rampant acceleration in the monetary stimulation and go toward a world where they start to pull it back. Could that help relieve some of the bubblets?
Well, I think so. I think that the real issue I've had with the Fed's monetary policy framework for a while now is that it focuses too much on just consumer price inflation. And there is not enough attention paid to asset price inflation. And I think that this is an outdated framework, because if you look at the past few recessions in both the United States and in other parts of the world, what you see is that most recessions now are caused by financial instability. And how do you get financial instability? You get financial instability when an asset bubble typically goes bust.
And finally, Ruchir, even if there is a bubble or a bubblet that goes bust, the air really comes out of it. Could there be some good that comes out of it? I mean, you talk in your piece in the Financial Times, actually, about what happened with the tech bubble, if I can call it that, in the late 1990s into the 2000s.
Yeah, I distinguish here between good and bad bubbles. There is something like this. All bubbles have negative consequences once they burst, but something comes out of a good bubble compared to a bad bubble. What do I mean by that? A good bubble, I mean, if it's happening in industries such as technology. We saw that in 2000, that a lot of the ideas in 2000 were premature. A lot of the digital infrastructure that was set up there lay waste for a while, but it did set the scene for the tech revolution to take place a few years later. So generally, tech-oriented bubbles tend to be good. Something good comes out of it. And I think that's true because it attracts a lot of capital. So whether it's got to do with some of the clean energy concepts just now, it's got to do with concepts like teleconferencing, and those stocks may not have earnings today, but something good comes out of it.
Okay, Ruchir, thank you so much for your time today. That's Seth Sharma of Morgan Stanley. Coming up, we wrap up the week with our special contributor, Larry Summers of Harvard. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin, and we're going to conclude our week with Larry Summers, our special contributor from Harvard, as we do every week. So, Larry, welcome. Good to have you here. I have to ask you, do you feel vindicated? The Fed actually at least somewhat caught up with you, I think, this week in saying we do, after all, have to be concerned about inflation, transitory or otherwise. So are you feeling good today?
David, look, I think the Fed signaled that it recognized that we were in a different place than it had expected on inflation. The best measure of that is if you look at what the market is now saying about real interest rates over the next few years. You saw an unprecedented, or nearly not unprecedented, but very large 5 standard deviation move in the market's expectation around real interest rates because of what the Fed signaled, principally with the dot plot. You saw that happening without the Fed changing in a major way its forecast of economic growth or its forecast of medium-term inflation, simply marking to reality its near-term inflation forecast. So I think you did see on Wednesday, a signal that the Fed had changed its reaction function in a significant way. I think that was an appropriate change given the inflation reality. There was a lot of volatility under the surface in markets, so I think they're still processing what happened, and you shouldn't try to read every detail as fitting together in a pattern. But I think yesterday will be remembered much more than most FOMC meetings as the beginning of the Fed's recognition that overheating is the issue that it has to deal with going forward. And given that overheating has been a major concern of mine, I'm glad to see that they have that recognition. But look, at a certain point, Churchill talked about it not being the end, it not being the beginning of the end, but maybe it being the end of the beginning. And I think with respect to recognizing that the economy's now in a very different kind of place where demand pressures are a crucial issue, I think that's exactly what we have seen here. And I was glad to see in particular the change in the dot plot, which showed that the basic implausibility in a labor short economy of rates being at zero out to 2024 is something that now a majority of the members of the FOMC recognize.
Yeah, so Larry, they get the issue now. I think it's fair to say. They've said 13 of the 18 members think the risk on inflation is the upside. So they get the issue. But are they doing anything about that issue? Because they moved some dots on their plot, to be sure, but they didn't actually cut back on their bond purchase, $120 billion a month. As you pointed out, that's increasing the accommodation, much less touch the rates. And by the way, if anything, it's a little surprising. The rate on the 10-year remained in the 1.5 range, and the equity markets, they sold off some, but it wasn't that dramatic. So are they doing anything about the fundamental underlying causes of this overheating, as you describe it?
I think we're going to have to wait and judge that. An optimistic view would be that because they signaled that they were on the case, that was reassuring to everybody that the accident that people feared was less likely to happen. And that's why equities were relatively tranquil. That's why the 10-year came down. After all, part of what the 10-year was pricing in was the risks I had been fearing, significant increase in inflation or the need for a major tightening at some point. So I think an optimistic view of those developments would be that, in fact, by changing expectations and changing their signals, that is policy in the monetary sphere, and they were rewarded for it.
Larry, I certainly take your point about the danger of over-interpreting the markets and what they're telling us, but address one thing in particular, and that is the flattening of the yield curve, because one of the things that happened this week was a pretty dramatic flattening of the yield curve. So the short end came up because the Fed certainly could drive that quite immediately. At the same time, the long end didn't. If anything came down, does that reflect the fact that the markets might think that maybe they are getting their arms around inflation?
It reflects two things, and in just what proportions is hard to know. I think it reflects certainly an expectation that they may be getting their arms around inflation. But, you know, inflation expectations moved hugely between the beginning of the day yesterday and the end of the day yesterday. They moved way down at the beginning of the day. That would have been very much like what you said. But by the end of the day, they had moved back up by 10 basis points. That's why I'm resisting an overinterpretation of those data. It may also be that if you thought that we were going to need to have some kind of big collision between monetary policy and the economy, those kinds of collisions send long rates way up. And we probably have taken out a bit of the risk of that kind of collision. So, and we've made the world probably a safer place and taken risk premiums out. So I think all of those things are contributors to the flattening of the curve. But David, I've learned in this that it's easy to form a beautiful theory around a market pattern and then have that pattern dissipate on you 2 days later. And so I think the more detailed the pattern one's commenting on, the less confident one should be in prescribing a detailed theory.
Yeah, fair enough. A point really well taken. Larry, you've always been very careful in saying you're not going to advise the Fed on what it should do. So I won't ask you to advise it what it should do from here on out, but I'm going to ask you, based on what you know, given the fact it now recognizes the issue in inflation and where it is, what you expect over the next few months, because people are talking about when they might announce the tapering, when it might actually take effect, how long it would take, when we'll really get some rate increases.
Look, my guess is that inflation is obviously going to have a transient element. It's been running at 8%. Nobody thinks it's going to stay at 8%. The question is whether the transient element is 4% or whether the transient element is 6%. And so how far down it's going to come. And I think the transient element's a little smaller than many other people do. I think the Fed's watching the data very, very closely. You saw that in this statement. And so my guess is that the adjustments are going to come on the sooner side of the distribution of expectations rather than on the latter side of expectations. And if the data come in as I expect they will, that will certainly be an appropriate set of changes.
Larry, going back in time, you warned about the danger of overheating literally the day that President Biden announced his American Rescue Plan, about the massive fiscal infusion that he was asking for. So you got that issue early, and it appears that other people now are catching up. I'm going to push you now and say, what's the one we're missing? What's the next one around the corner that we may not be paying enough attention to?
I think we need to be careful what we do with our trade policies and our regulatory policies, and we need to make sure that we make the huge corrections that are necessary to Trump-era policy on taxes and regulation and microeconomics. We need to raise the minimum wage. We need to be more supportive of unions than we have been. We need to do more on the green side. We need to raise corporate taxes. But I think we need to be careful to maintain a positive climate for business going forward.
Okay, Larry, it's always great to end our week with you. That is our special contributor, Larry Summers of Harvard. Coming up, one final thought on the new federal holiday, Juneteenth. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. Finally, one more thought. Going back to go forward. The important events of this week went beyond summit diplomacy and Fed adjustments. The week ended with Juneteenth, named for June-19, 1865, when federal troops entered Galveston, Texas, to announce that the Civil War was officially over and that all slaves in the state were free. It was the last state in the Union to receive word, and it was 2.5 years after the Emancipation Proclamation had taken effect. Juneteenth, or Jubilee Day, has been commemorated by some Americans as far back as 1866, when black citizens in Texas held celebrations. It's been an official state holiday in Texas since 1980, and is now a holiday or a day of observation in 46 states. Still, a Gallup poll this month found that some 60% of Americans knew nothing at all or only a little bit about Juneteenth. It took the police killings of black citizens like George Floyd and Breonna Taylor last year to put it on the national agenda. And this week, we made Juneteenth our 11th national holiday.
The bill is passed.
There is no doubt that it is an important day in American history. But what does Juneteenth have to do with Wall Street and financial markets and business? Well, some of the most prominent corporations in the country have made it an official company holiday. Places like Twitter and the New York Times and Quicken Loans. And in the end, it's not so much about commemorating a day as it is making up for so much lost time in making sure that everyone is included in the workplace as well as in life. Bank of America CEO Brian Moynihan says when he sought a way to measure that inclusion, he asked his fellow workers.
A young woman came forward and said, I want to be able to come to work and not have to leave myself at the door and pick it up on the way home and be successful. That's a great definition. So we've been using that definition to say, come to work, be yourself, and you can be all you want to be in this company based on your motivations, your talents, but you don't have to leave, you don't have to park who you are and how you got here at the door. That is critically important.
I worked for one of the best and the most successful CEOs of his generation, Tom Murphy of Cap Cities. And I remember the day he came into the office and said that as he looked around at his senior management team, he realized we were leaving on the sidelines more than half of the brains and the talent because of the underrepresentation of women and people of color. No, this isn't about woke. It isn't even about doing the right thing. Juneteenth is a day to reflect on what we all need to do to include everyone in the effort to be our collective best. That does it for this episode of Wall Street Week. I'm David Westin. This is Bloomberg. See you next week.